Have you ever asked, am I making the most out of my money when it comes to saving and investing in Canada? You've probably heard of two popular tax-advantaged accounts, the TFSA and the RRSP. Each promises benefits, but you might wonder which truly fits your situation. Don't worry, you're not alone, and today we'll clear it all up. In this video, we'll take a comprehensive look at the tax-free savings account, TFSA, and the Registered Retirement Savings Plan, RRSP. We'll dive into their differences in taxation and contribution strategies and how each can support your financial goals. Whether you want easy access to your funds or to secure a robust retirement income. We'll also address the unique considerations that business owners and entrepreneurs face when deciding between TFSAs and RRSPs. By the end, you'll be equipped with the knowledge to pick the best path for your hard-earned dollars. Let me share a client story that really highlights the importance of choosing the right account. A while back, I spoke with someone who had saved up a decent sum of money. She had always heard that TFSA was the best option because tax-free sounds like a no-brainer. Then another group of friends said, no way, you need the RRSP to reduce your tax burden this year. Unsure of which was right, she scheduled a consultation. We took a close look at her current and expected future income, her career trajectory, and when she might need to tap into these funds. It turned out that although the RRSP offered an immediate tax reduction, her future plans and potential for higher income in retirement indicated that a TFSA focus would be more advantageous in the long run. She was relieved to realize that following one-size-fits-all advice could have cost her a lot more in taxes down the road. This story is far from unique. Many people feel torn between two compelling options. Let's break down each type of account piece by piece so you can make an informed decision that aligns with your personal and financial goals. What are the core differences between the TFSA and RRSP? The first one is tax treatment. When you contribute to a TFSA, you're using after-tax dollars, meaning you don't get a tax deduction when you put the money in. However, any growth, whether it's interest, dividends, or capital gains, accumulates tax-free. And the real kicker, when you withdraw money, those funds come out tax-free as well. On the other hand, RRSP contributions are tax deductible, which can reduce your taxable income for the year you contribute. This often results in a nice tax refund, which most people look forward to. But here's the flip side. When you withdraw from the RRSP, typically in retirement, the money is taxed at your then tax rate. When does the RRSP or TFSA shine? The TFSA is ideal if you anticipate being in a higher tax bracket in the future, or if you want your money to grow without facing taxes when you decide to withdraw. It's also excellent if you're looking for an emergency fund or a mid-term savings vehicle, as you can pull out funds with no tax consequences. The RRSP, on the other hand, works wonders if you're in a higher tax bracket right now. By reducing your taxable income through an RRSP contribution, you're effectively deferring taxes until retirement, when presumably your income may be lower and you'll be taxed at a reduced rate. Here's an example. Imagine you earn a solid income today, and you anticipate that your salary might level off or even drop completely when you retire. In that scenario, prioritizing RRSP contributions might help you save thousands in taxes now, and you'll withdraw those funds at a hopefully lower rate later. Conversely, if your income is on a steep upward trajectory, you might face significantly higher taxes in the future. Putting funds in the TFSA ensures that any withdrawals when your tax rate could be at its peak won't be taxed at all. By grasping these fundamental differences, you'll be better equipped to decide how both accounts can serve your needs now and in the future. Contribution limits and penalties. Each year, the federal government sets a specific contribution limit, and if you don't max it out, the unused portion carries forward indefinitely. This is a major perk for those who can always contribute each year. The room is never lost. If you exceed your TFSA contribution limit, the Canada Revenue Agency charges a penalty of 1% per month on the excess. It can add up pretty quickly, so it's vital to stay within your limit. RRSP limits. Your RRSP limit is based on 18% of your earned income from the previous tax year, up to a government-mandated maximum. Unused contribution room also carries forward to future years. Going over your RRSP limit can be equally damaging. While the CRA allows a small buffer, usually about $2,000 above your limit without penalties, exceeding that comes with monthly fees and the need to correct the excess as soon as possible. Keeping track of your contribution room for each month is essential. Many people only look at their notice of assessment once and forget to check it throughout the year. If you're unsure, it's worth logging into your CRA My Account portal or reviewing your annual statements from the CRA to confirm your contribution room. If you plan on making large lump sum contributions, like applying a work bonus or an inheritance, double-check your limits to avoid unnecessary penalties. Future income and tax brackets. Taxes in Canada are progressive. The more you earn, the higher the marginal rate you pay on the top portion of your income. So contributing to an RRSP while you're in a higher tax bracket results in significant tax savings. With the TFSA, you don't get a break on your contributions now, but it spares you from taxes entirely on what you withdraw later. Predicting your income. It isn't always straightforward to predict your income, but consider factors like promotions, career changes, or even changes in your family circumstances. For example, if a spouse might take time off. If you expect your taxable income to jump significantly, leaning on the TFSA during lower income tax years and favoring the RRSP during higher income years might be a balanced approach. If retirement is decades away, you might rely on TFSA for flexibility now. Then, as you advance in your career and your income grows, you can pivot to maxing out your RRSP to capture higher tax deductions. Here's an example. Suppose you're making a comfortable salary today, but you foresee a big income leap in the next 5 years, maybe from a major promotion or scaling your business. You could contribute modestly to your RRSP now and put more in your TFSA. Then when you hit that higher tax bracket, you ramp up your RRSP contributions to maximize immediate tax savings. The fourth factor to consider is flexibility and access to funds. One of the biggest draws of the TFSA is ease of access. You can dip into your funds at any time without taxes or penalties, aside from losing out on potential investment growth if you withdraw too soon. Another bonus is that whatever amount you withdraw this year becomes fresh contribution room next year. This cyclical replenishing of contribution space is ideal for saving for multiple goals over time. RRSP for retirement focus. The RRSP is primarily designed for retirement savings. You generally don't want to tap into it early because you get taxed on withdrawals at your marginal rate and you lose that contribution room forever, with the exception of some special programs. The unbiased plan and the lifelong learning plan let you withdraw from your RRSP without immediate tax penalties, provided you pay those funds back into your RRSP over time. This can be great if you're purchasing a home for the first time or going back to school for career advancement. Balancing liquidity and security. If you anticipate big purchases or potential life changes like starting a business, going back to school, or taking a sabbatical, the TFSA's liquidity becomes especially attractive. But if your primary goal is retirement and you prefer to keep your hands off those funds until your golden years, the RRSP can offer the discipline you need, combining both accounts. Why one size fits all doesn't apply. Personal finance is personal for a reason. Some people see big tax refunds from RRSP contributions as a motivation to save more. Others love the flexibility and tax-free growth of TFSAs. In many cases, there's no need to pick just one. Many Canadians contribute to both, leveraging the immediate tax relief of the RRSP while still building a tax-free pot in their TFSA. This strategy can hedge against future tax uncertainties. Here's a practical scenario. Suppose you receive a large year-end bonus that bumps you into a higher tax bracket. You might direct most of that bonus into your RRSP for a substantial tax break. Meanwhile, throughout the year, you can funnel smaller amounts into your TFSA, ensuring you have some savings readily available if an opportunity or unexpected expense arises. This dual strategy helps you tackle both long-term retirement objectives and short-term liquidity needs, all while enjoying diversified tax benefits. Having both accounts can also psychologically encourage better saving habits. Knowing that your RRSP is locked in for retirement might keep you from raiding it for impulse purchases, whereas your TFSA remains readily accessible if something truly urgent comes up. Additional considerations for entrepreneurs and business owners: salary versus dividends. If you're a shareholder in your own corporation and primarily pay yourself dividends rather than a T4 salary, your RRSP contribution room might be limited. RRSP room is calculated on earned income, and dividends don't typically count as such. A TFSA can especially be useful because it doesn't require earned income. If you do choose to pay yourself salary for the sake of building RRSP room, keep in mind you'll be subject to payroll taxes, CPP, and possibly EI. There is no one-size-fits-all answer. It depends on your overall tax strategy. The second point to consider is retained earnings versus personal investing. Many entrepreneurs grapple with whether to keep profits in the corporation or withdraw them personally. Investing within your corporation comes with its own set of tax rules, especially around passive income. Taking funds out to invest in a TFSA or RRSP could result in a personal tax hit upfront when you pay yourself a salary or dividend, but it may yield more flexible or advantageous growth if structured correctly. Compare your corporate tax rates versus personal tax rates and consider the long-term implications. There are advanced strategies you can also consider. Individual pension plans, IPPs. An IPP can be a powerful retirement vehicle for incorporated business owners, potentially offering higher contribution limits than an RRSP. However, it comes with setup costs and ongoing administrative requirements. TFSAs can still be used alongside IPPs for more tax-free room. Another advanced planning tool you can consider is a corporate-owned life insurance. This is often used in conjunction with retirement strategies. While this goes beyond the scope of TFSAs and RRSPs, it's a reminder that entrepreneurs have several sophisticated options to explore for tax and estates planning. For business owners, a strong financial plan might include a blend of TFSA, RRSP, corporate investing, and advanced structures. Understanding how each piece fits together is key to minimizing taxes and maximizing growth. If you're an entrepreneur or self-employed, do the math on how much earned income you plan to generate. If your earned income is low, your RRSP room will be limited, pushing you to rely more on TFSAs. On the flip side, if you opt to pay yourself a higher salary for RRSP purposes, balance that with the costs of payroll taxes and potential benefits of future RRSP deductions. Your decision can have ripple effects on both personal and corporate finances, so consider professional guidance. If you want to see how RRSPs and TFSAs fit together in the bigger picture of upcoming tax changes, make sure to watch my video, Top Tax Changes in Canada for 2025. There, I discuss how to use these registered accounts alongside new regulations to keep more of your money where it belongs, working for you. Thank you so much for watching, and see you in the next video.